If you're scanning your portfolio right now, looking for a balance sheet that practically prints its own cash, you're probably hunting in the tech sector.
Right, like a software monopoly or something.
Exactly, or a global logistics network, maybe a cloud computing giant. You certainly aren't expecting the underlying asset of a financial fortress to be, well, a reclaimed mudflat from the 1960s.
Yeah, I mean, mud flats and a very famous mouse. It sounds almost too simple when you strip it down to just those two elements.
But when you actually dig into the financial realities of the Oriental Land Company, the powerhouse operator behind Tokyo Disney Resort, that simple picture becomes a brilliant blueprint for corporate strategy.
It really does.
So welcome to this Japan Stock podcast edition of our Deep Dive. Our mission today is to decode exactly how that 1960s land reclamation project in Urayasu was engineered into an absolutely impregnable business.
And to understand how they built those defenses, we really have to view their history as this drama of adaptation.
A drama of adaptation. I like that.
Yeah, because the Oriental Land Company, or OLC, hasn't just managed to survive economic downturns or, the devastating 2011 earthquake or the pandemic closures.
Right.
They have actively internalized those historical scars. Those vulnerabilities were basically forged into their current strategic armor, which they internally call their quality journey.
And to rigorously analyze that journey today, we are applying a strict 80-20 rule.
Which is so important here.
It is, because OLC has a whole laundry list of minor subsidiaries. We're talking monorail operations, theatrical productions, you name it.
But we are ignoring all of that noise today.
Exactly. We are focusing purely on the core engines driving over 80% of their profit.
Meaning the theme parks and the hotels. Everything else is just a distraction.
Which means our very first step has to be redefining what this company actually is. If you just pull up their official corporate description and see theme park operator, you are completely missing the mechanics of how they make money.
You're missing the whole plot.
Yeah. The technical reality of OLC is that they are an elite case study in real estate and intellectual property monetization.
Right.
Decades ago, they secured vast, highly strategic tracts of land outright, sitting right on the doorstep of central Tokyo.
Which is prime real estate.
Unbelievable real estate. Then, they supercharged it with an ironclad master license from Disney Enterprises. They don't just sell admission tickets, they aggressively monetize the absolute geographic limits of that physical space.
Let's translate that into a framework that, a modern investor feels in their bones. You shouldn't look at OLC as a traditional theme park.
What are they then?
You need to look at them as a high-end, lifetime subscription service.
Oh, interesting.
Think about Costco or Netflix, companies that live and die by their retention metrics.
Okay.
OLC boasts a staggering 90% repeat visitor rate among their domestic guests.
Wait, 90%?
90%. I mean, you don't just go once. You are habituated to return. You go as a child, you go as a teenager on a date, and eventually, you go as a parent bringing your own kids.
Hold on, I have to stop you right there. A 90% repeat rate is an incredible metric, but isn't it inherently, almost existentially dangerous to build a multi-billion-dollar empire on rented land?
You mean the rented intellectual property?
Exactly. If Disney decides tomorrow to drastically alter the licensing terms, or if that specific IP just loses its cultural dominance, doesn't that entire subscription model just collapse overnight?
It's a completely logical fear, and it is exactly why OLC doesn't rely solely on the IP.
Okay, so how do they hedge that?
They use a strategy very similar to Apple's walled garden. Yes, the Disney characters are the initial hook, the shiny hardware that gets you in the door, but the real retention comes from the ecosystem.
The physical ecosystem.
Right. They have an unbeatable owned location just 15 minutes from Tokyo Station. But more importantly, it's the hospitality of their cast members.
The employees.
Yeah. The employees create this level of spatial immersion and frictionless psychological comfort that transcends the characters themselves. Even if a rival park licenses the hottest new movie franchise, they cannot easily replicate that deeply ingrained, flawless hospitality.
That makes sense.
That immersion is the actual product, keeping the 90% locked in.
But, you can't truly appreciate the genius of that lifetime subscription until you see what happens when a company tries the exact opposite approach.
Oh, you mean the virtual battle playing out right now in the Japanese leisure market?
Right. If you pit OLC against its primary domestic rival, Universal Studios Japan, you see this really fascinating strategic split.
Yeah, USJ is an incredibly sharp operator, but they have undeniably chosen a completely different path. Let's call it Path B.
Okay, lay out Path B for us.
Their strategy relies heavily on thrill rides and a constantly rotating, highly aggressive roster of pop culture IP. We're talking anime, hit video games, blockbuster movie tie-ins that change by the season.
So they're chasing trends.
Exactly. It creates sudden spikes in attendance. It's a hit-driven model. It functions very much like a Hollywood movie studio relying on the summer box office.
Whereas OLC chose Path A, unwavering brand loyalty and total resort immersion.
Right.
They aren't trying to spike Q3 attendance with a temporary roller coaster overlay. They're optimizing for lifetime value. And that creates a drastically wider economic moat.
Because of the ownership structure.
Yes, because OLC owns the underlying land, the adjacent hotels, the shopping complexes, and the transport loop connecting all of it, they capture virtually every single yen a guest spends.
Wow.
From the moment you step off the train until the moment you leave, you never interact with a third-party vendor. It is total economic capture.
But all that loyalty comes with a staggering price tag. Maintaining an ecosystem that demands a 90% repeat rate means your capital expenditure can never, ever stop.
You have to keep spending.
Right. If you want to keep ahead of USJ's hit-driven spikes, this quality journey OLC talks about demands continuous reinvestment. You have to constantly update both the software, the parades, the shows, and the hardware of the park.
Which means replacing aging infrastructure with multi-billion yen expansions.
Exactly.
And for a long time, the domestic Japanese market supplied the free cash flow to fund that construction. But if your domestic base is already saturated, practically capped out at that 90% repeat rate, where does the aggressive new revenue come from to feed that CapEx engine?
That is the multi-billion yen question right there. And the answer has become almost entirely reliant on the inbound tourist wave.
We are seeing this play out in the hard data right now. If you look at the numbers from the first quarter of fiscal year 2026, we saw record high overseas guests.
It's been wild to watch.
Unprecedented levels, both in sheer volume and as a ratio of total attendance. The extraordinarily weak yen has essentially put Tokyo Disney Resort on clearance sale for the rest of the world.
True, the exchange rate is a massive tailwind. But we have to give OLC's management credit here. This isn't just accidental luck.
What do you mean?
Well, they saw the ceiling approaching on domestic growth and made a highly intentional pivot toward overseas online travel agencies, or OTAs. Think platforms like Expedia or Klook.
I see.
They realized they couldn't just sit in Urayasu and hope tourists showed up at the front gate. They're executing precision online marketing to capture traveler intent before the flights to Narita are even booked.
They're locking them in early.
Exactly. They are reaching into living rooms in Seattle and Singapore to lock in that ticket revenue early, which guarantees the cash flow regardless of whether it rains on the day of the visit.
It's clearly working. I mean, we are tracking a robust recovery and outright growth in guest numbers from North America, Southeast Asia, and broader East Asia.
It's a huge shift.
It is fundamentally shifting the demographic makeup of the crowd on any given Tuesday.
It is working, absolutely. But it introduces a dangerous new layer of fragility to the business.
Because of the reliance on international travel?
Yeah. While the overall international numbers are breaking records, mainland China still hasn't fully returned to its pre-COVID levels.
Right, that's a big missing piece.
And international travel intent is incredibly sensitive to external shocks. Like, just look at July of last year. A prominent earthquake prediction circulated in the news, and it temporarily tanked visitor numbers from Hong Kong.
Wow, just from a prediction.
Right. It was a brief anomaly, sure, but it perfectly illustrates how quickly international revenue can vanish over a headline that OLC has absolutely zero control over.
Just stop and let that sink in for a second. If a single news cycle can suppress your fastest growing demographic, you are operating with a very real vulnerability.
Exactly. You are trading domestic stability for international volatility.
Okay, so they are flooding the parks with international tourists and dealing with that volatility, but does that actually move the needle on their bottom line? Let's look at the engine room.
The hard numbers.
Right. How do these marketing shifts hit the earnings per share and the operating profit? When you break down the latest full-year financials released in late April 2026, the strategy proves its worth.
Oh, absolutely.
Operating profit hit an impressive 168.4 billion yen. and their operating margins are holding incredibly strong, specifically 23.9%.
We really need to pause and contextualize what a nearly 24% operating margin means in a physical, labor-intensive hospitality business.
It's almost unheard of.
That is staggering efficiency. Most hotel and leisure operators would kill for half of that. And to visualize where that explosive growth is coming from, you have to look past the front gates of the theme park and look at the hotels.
The hotels are the secret weapon here.
They really are. In just 12 months, their hotel segment's operating profit jumped nearly 21% to roughly 36.8 billion yen.
Which is just massive.
Right. To put that in perspective, in a single year, their hotel segment alone added pure profit equivalent to the entire annual revenue of a mid-sized competitor.
Let's break down the mechanics of why that hotel profit jumped so dramatically. It's what we call the multiplier effect in hospitality.
Okay, how does that work?
Think about how a hotel operates. It costs OLC the exact same amount to run the air conditioning, maintain the lobby, and pay the front desk staff whether the guest is paying 20,000 yen or 40,000 yen a night.
Oh, I see. The fixed costs are already covered.
Precisely.
Yeah.
So when the weak yen allows them to aggressively raise room rates for inbound tourists and they max out occupancy, every single extra yen charged goes straight into pure profit.
It just drops right to the bottom line.
It creates a self-sustaining loop of profitability where the hotels act as the highest margin engine in the entire portfolio.
And this brings us to the ultimate tension for any management team generating this much free cash flow: capital allocation.
Yes. What do you do with the cash?
What are they actually doing with all this money? Are they genuinely adopting a shareholder-first mentality, or are they just empire building with endless park expansions?
Well, if you look at the truth in the cash, there is a very deliberate, calculated balancing act happening. On one side of the ledger, you have the immense capital expenditures we talked about, new immersive lands, massive R&D projects.
Yeah, they love to build.
But on the other side, they are aggressively managing their equity to reward investors. They've actively engaged in stock splits, notably the 5-for-1 split in April 2023.
Which was a brilliant move to democratize the stock.
Exactly. For our global listeners, Japan has a tax-free investment program called NISA, designed to encourage everyday citizens to invest their savings.
Right.
By splitting the stock 5-to-1, OLC took a share price that was previously out of reach for a normal household and made it accessible. They specifically targeted retail investors through NISA.
And it pays off.
It really does. When you calculate the estimated yield for long-term holders of 100 shares, the math is incredibly compelling. You factor in the cash dividends, the regular long-term shareholder perks, which are essentially free park tickets, and the upcoming special 30th anniversary shareholder benefits scheduled for 2026.
That's a lot of value.
When you combine all that, you are looking at an estimated yield of over 10% for those long-term retail holders. That appeal stretches way beyond institutional analysts. It is an incredible draw for retail investors and hardcore Disney fans who want a piece of the action.
It is a highly attractive package, but we still have to critique management's heavy reliance on that capex side of the ledger.
You think it's too much?
I know some analysts view the endless construction, the new themed ports, as vanity projects. They think management just likes building things.
Sure, that's a common critique.
But if you truly understand that quality journey philosophy, you realize continuous expenditure is a defensive necessity.
To protect the moat.
Exactly. To keep that 90% repeat rate from decaying, to ensure the lifetime subscription doesn't get canceled in favor of a trip to USJ, they have no choice. They have to reinvest heavily just to maintain their position.
I hear the strategic logic, but let's be realistic about the macro environment for a second.
Yeah.
Isn't that assumption incredibly optimistic given the current economic situation?
You mean a potential recession?
Yeah. If a severe macroeconomic recession hits, or if domestic Japanese wages stagnate further, all of those multi-billion yen construction projects suddenly transform from growth engines into dead weight on the balance sheet.
That's the risk, yes.
You cannot simply pause construction on a massive new steel roller coaster just because consumer spending dips for a quarter.
That is the exact tightrope they are walking. They are betting billions of yen that their brand equity is strong enough to act as a recession-proof utility.
That's a bold claim.
They are banking on the psychological reality that a Japanese family will cut back on dining out, delay buying a new car, or skip buying new clothes long before they cancel their annual trip to the resort.
Which brings us to the professional prudence part of our deep dive, because it's very easy to sound like a cheerleader when a company is posting an operating profit of 168 billion yen.
Oh, absolutely. But as analysts, we have to look at the horizon.
Right. And there is a massive, unavoidable blind spot in this entire operational model. Despite the current inbound tourist boom we just discussed, Japan faces a severe demographic time bomb.
The shrinking population.
Precisely. We are looking at a rapidly shrinking youth population, which has historically been their core audience. But perhaps even more critically, it means a sharply declining labor force.
Right, the staff.
OLC relies on tens of thousands of cast members to run the rides, clean the massive resort, and deliver that premium immersion we praised earlier.
Yeah.
Stop and think about that for a second. If the domestic youth pool dries up, the fundamental math of the business breaks down. Who buys the lifetime subscription?
And more importantly, who actually staffs the park to fulfill it?
Exactly.
It is a structural macroeconomic headwind that no amount of licensed magic can simply wish away. You can't outsource in-person hospitality.
No, you can't.
And that demographic reality perfectly explains why their most recent strategic moves are so critical. If domestic demand structurally wanes because there simply aren't enough young people, their aggressive pivot to capture inbound tourists isn't just about boosting margins.
It's about filling the gap.
Right. And their exploration of entirely new revenue models, like their recent foray into the cruise business, isn't just extra credit for the balance sheet. It is an act of existential survival.
Wow. Yeah.
They have to find ways to monetize their incredible brand equity that aren't strictly tied to domestic birth rates or the physical geographic limits of Urayasu. They have to take the ecosystem to the consumer, rather than waiting for the consumer to come to the ecosystem.
So to pull all these threads together, what we are looking at is a textbook example of strategic evolution. The Oriental Land Company engineered a piece of reclaimed land into an absolute financial fortress through unparalleled brand loyalty, relentless capital reinvestment, and an almost ruthless optimization of real estate.
A literal fortress.
They turned historical scars into the armor of their quality journey, building an economic moat that captures total value from a captive, highly habituated audience.
But as we've laid out today, the walls of that fortress require constant, expensive maintenance.
Right.
They've unequivocally conquered the domestic market, but the next decade of their story will be defined entirely by their ability to navigate Japan's demographic decline and the inherent unpredictable fragility of global tourism.
Which leaves us with one final, vital question for you to consider as you evaluate this stock for your own portfolio. If Japan's domestic labor pool continues to shrink, and another unpredictable global event suddenly halts international travel, can a company built entirely on physical, shared spaces pivot its business model fast enough to survive the next 3 years?
That is the big question. Thank you for joining us on this edition of the Japan Stock Podcast. Keep questioning the numbers behind the magic.